again, everybody, and welcome to another in Legal Eye's series of coffee break webinars. We're fortunate enough today to be joined by Martin Ellis, the Executive Director of Howdens, and Colin, the Divisional Director. And we're going to be talking today around the risk profiling of firms for insurance renewals, and also looking at the Howdens market report that was issued in January 2021, looking at how market trends had gone through 2020. Clearly, it was a somewhat unique year, Martin, and you predicted very accurately in your July report that April's figures would show very much a hardening of the market. You also then predicted later that the October 2020 renewals would see a hardening of the market. Is that what you actually saw?
Yeah, Paul, absolutely. As you say, a unique year. It was quite interesting, actually. On the 1st of April last year, we were only at that point a week into lockdown, right? So it was quite an interesting one because insurers were just adapting themselves to what was going on. But we did see a hardening at that point, which probably started in the 2019 year, you know, in April and October of those years as well. So it was a continuation of that, driven by adverse claims activity and a general feeling that, you know, the rates needed to increase across the board. What we saw in October was an interesting situation because we were a few months into the lockdown period at that time. There was a fear amongst insurers that, you know, the country was going to hit a deep recession, you know, in the not too distant future. And of course, as we know, claims against law firms tend to increase during recessionary times. So there was a genuine fear factor there. So insurers were once again looking at the economics, the potential of recession, the remote working risks. You know, these are all really important things that insurers were taking and factoring into account. And when we got through to the 1st of October, there were firms of different sizes and involved in different areas of practice and had different risk profiles as a result that did probably, I would say, pay in rate terms, i.e. the rates that they would charge would probably increased by on average 20 to 30%, I would say. It can't be definitive, that number, across all firms of all sizes, of course, because some firms would have paid significantly more than that. And, you know, the reality is that the choices for firms in relation to the number of insurers that they had available to them was generally restricted. I'm not suggesting there wasn't options, there was, but you had to be, you know, strategically in a good place as far as your planning was concerned. With insurers, and the way that you approach things and the way you presented yourself to insurers was hugely important. So, you know, and also the other big thing for me is that we talk about these rate increases and premium increases. For firms, of course, it does affect the compulsory level of insurance. But a number of firms do buy higher limits. And, you know, some firms buying, you know, some of the very, very large firms buying hundreds of millions of pounds cover. And of course, the rates that were applied by insurers did not only apply to the primary level of cover, the compulsory level, but also those excess layers, as we know them to be. And some of those rates charged for the excess layers were significantly, in pure sort of proportionate terms, a lot higher than the primary layers, because there was a general feeling, or is still a general feeling in the insurance market, that a correction of those rates needed to be done, and quite quickly. It's really been driven by claims activity. The severity of claims, the value of some of the very large claims has affected those insurers to the point where, to continue underwriting on those excess layers, they had to correct the rates. I'm afraid to say that those underwriters would have pulled out, and then that would have left us with a real capacity issue. So the 20 to 30% that we were talking about, that we were predicting, did come to fruition. Not for all firms, as I say. Some were less, some were more, and some firms were probably restricted in the number of options that they had available to them.
Okay, that's great. I mean, that it's incredibly helpful for firms to get a general perspective on what the market's doing, whether that's for larger firms or smaller firms, because clearly that is going to vary considerably across the piece. But I think what probably is really helpful for firms, Colin, from your point of view, from the risk management side, is what are you seeing that firms are able to do in order to improve their profile with insurers, and what helps you? Because I think sometimes firms do slightly forget that actually the more they do, the more it helps you in order to put them in a good light before an insurer. So on the risk side, how are you seeing things?
Well, never a more challenging year for a risk manager, for starters. I mean, crikey, how much have they got on their plate looking after a firm? Suddenly, things that would have naturally taken 5 years to probably put in place, remote working for everybody and case management systems and goodness knows what, almost had to be done overnight. So my hat goes off to everybody that's running a law firm or in risk management. But the issues that we're seeing really are, there's very few new ones, but they've just been heightened. And the firms that are generally quite well run, I've seen some disruption, but not catastrophic. But there have been some firms that it's been, very, very difficult to suddenly, shut your office and pick up and run. So what an insurer really wants to know is that even if you've got a good claims record, which is great, by the way, but they want to know it's not through luck. And that's a key thing. They want to know that it's a well-run firm, that is less likely to have claims. And one of the most important things from risk management, in my opinion, and I've been involved in law firms risk management for about 30 years, is speed of detection. So that when you find something, if something's gone wrong, you found it quickly. Because with claims made policies, it could be, 3 or 4 years down the line that you identify, excuse me, an issue. But what we don't want to do is find that issue's been replicated 100, 200 times, and we didn't pick it up early enough. So I think from an insurer's point of view, they want really good active supervision, and that's been a challenge. To do that remote working. I understand that. Some firms actually supervision, I think, has improved through, these sort of mediums, more engagement with their staff. But those water cooler moments are few and far between. The trainees and the newly qualified not necessarily picking up across an office what skilled long-term practitioners would be saying, given those areas. So I think supervision's one. Certainly from an insurer's point of view, still active FAR reviews. And I know that's not going to be something that necessarily is going to be top of your list when trying to implement IT systems, laptops, all of those sort of things. But it is important that we maintain what was there before as best we can, or get help on FAR reviews. So that sometimes independent FAR reviews, which I know you guys can get involved in, but there's a real value in that, particularly if you're up to your eyes in other work. Just maintaining that good behaviour is very important, not just from a PI point of view, but from a regulatory point of view, because the regulator certainly hasn't taken his foot off the gas with regulating the profession. So I think very, very clear understanding of what the firm is doing, how it has responded to COVID, how it's looked after its staff to ensure that they've got all the tools and the training that they need. And again, training needs to continue. We've nearly been a year, in lockdown off and on. That's very, very important. But certainly in areas, anything to do with conveyancing needs very, very good, clear controls, and increasingly in our area of concern is wills and probate and the like. But most of this comes back to, I'm almost tired of the words risk management, because I think really it's just good management, and identifying the areas that are most at risk allows you to target in your efforts to risk manage the areas that really need vibrant risk management, and not get so concerned on another area that might not need those. Anti-money laundering, clearly still a regulatory issue, but everything that's going on with onboarding clients, showing a clear understanding of the work that you're going to do, maybe the work you're not going to do, is what insurers are looking for. And I've scratched the surface just on this coffee. I mean, anybody who knows me knows I could talk for another 4 or 5 hours about all the things that people can do. But when it's a hard market like this, and people like Martin are in the trench actually negotiating with insurers, this extra information is the difference, not necessarily between you getting a 20% rather than 22% or whatever. It may be the difference between an underwriter offering you a quotation and not. And from our point of view, we've got to try and maximize the options for our clients, and good risk management and how you get that across to insurers has never been more important.
Can I add something?
Yeah, of course, Martin.
Yeah, I mean, one of the key themes from during the summer last year, and it's continued through to this renewal now on the 1st of April, right? So we are very, very ingrained in the renewal process at the moment. And one of the key themes has been about financial risk and the financial stability. Some insurers called it business resilience. I think at the end of the day, what we're really talking about is how firms are managing their financials, whether they're profitable, whether they're managing cash flow correctly, whether their budgeting is on target, both from a revenue and a profitability perspective. And what we've seen is quite a number of questions being asked by the professional indemnity insurers, not dissimilar to you would ordinarily see from a bank, for example, around how a firm manages its finances. And the reason is quite simple, really, that if a firm's financial position is somewhat suspect, then insurers are genuinely concerned about the way that business is being managed and the potential exposure of that firm unfortunately closing down for whatever reason. So these are the kind of risks that during tougher financial times insurers have started to really focus on. And we are seeing more and more in-depth and more intrusive questions, I think it's fair to say, around financials than we've ever seen before. A lot of the finance directors and COFAs, for example, in charge of the money within the law firms, are being asked to now make personal presentations to certain insurers, around the financials, even for firms that have been insured with the same insurer for many years. We're now asking for more information. There's a different layer of information that we're asking for. And, we should have probably always been asking those questions. But what has happened is, of course, that COVID and the potential economic impact of COVID has heightened awareness from the underwriters that they need to dig a bit deeper. So I think it's fair to say that Colin's absolutely right to highlight supervision, remote working, technology, and all that kind of thing. It's absolutely spot on. But that added interest from insurers now around their firm's financials has become probably more of a focus, I would say. And yes, we ask for financial information, but it's not always fully understood. So actually, firms to position themselves from a risk management perspective need to be thinking broader than just the obvious risk management things that they can put in place, to include the financial side. I think it'd be stuck with us for quite a while now. I think it's fair to say.
Yeah, and I absolutely echo, everything that Colin was saying, and I really like the fact that you also take the perspective that this isn't about risk management. That's probably a very outdated phrase now. This is about just running your business properly, and all of this is just what the market requires, and it's the way that we will have to deliver in order to achieve the required standard for insurance. And actually, if we manage the businesses properly and we carry out the brilliant suggestions and advice that you give, actually those businesses will probably run better and more profitably as a consequence, more naturally. So I really appreciate the contribution from you both on this. And we've split this coffee break into two because it's obviously such a large area. And the second of these will focus on the future and what we're seeing now running up to the April market renewal, and also looking forward to what then we might anticipate in October. As Martin, you've just rightly said, this isn't going to go away. This is the way that we function going forward, and therefore these are the things we need to adapt to now, so that whether you're renewing in April or whether you're renewing in October, you start and put these things into place and you start running your businesses well. So thank you very much indeed for your time today. Welcome. Very much appreciated. And we look forward to seeing you on the next of these sessions. Thank you.
No problem. Thanks.